Thanks for the opportunity to talk about my most recent book. It's called Active Retirement Investing. And the fun thing about the book is I wrote it for the do-it-yourself investor if you choose to do that yourself. It has a complete list of how to do your own personal financial planning and then your own investing, and gives you a list of what to do in monitoring everything. Or if you choose to keep your advisor and pay somebody to do that, then it tells you what that advisor should be doing for you. So I'm excited because we're not trying to just sell a book. You can get it free. I can give you a link to download it, but I like the idea of empowering people to do things themselves, or at least to be able to make sure they're not being taken advantage of by somebody that's just a broker and trying to make commissions off them.
Welcome to this edition of Retire Well, Retire Happy with your host, Annie Nelson. An Australian look at reinventing yourself for retirement and getting yourself retirement ready. It's always fascinating getting to know what people are getting up to in retirement, how they are supplementing their incomes, pensions, where they have chosen to live, how they are filling their time, what charities they are supporting, and what adventures they are having. And we'll also talk to experts in their fields, including investing, health, estate planning, financial advisors, and seniors healthcare.
Hi, welcome back to the Retire Well, Retire Happy show with your host, Annie Nelson. And here on the show today, I'd like to introduce you to my special guest. It's Hunter Bill Bailey, and it's my pleasure to put you in front of our audience today. He did not follow the traditional financial planner's path before building his current company and entering the financial field. Bill spent some time as a gymnast, and through this experience was able to attend a college university on a sports scholarship. He went on to achieve the level of collegiate All-American gymnast. He also was a reserve deputy sheriff for over 30 years. In his very early life, though he had to endure a troubling upbringing, he came out on top, being the first out of 5 family members to graduate high school and go on to college. He's well educated. He has a Master of Science in Financial Services, Institute of Business and Finance, Certified Fund Specialist, Certified Income Specialist, Certified Tax Specialist, Certified Annuity Specialist, and Certified Estate and Trust Specialist. Well, Bill, you should know everything, but wait, there's more. He used to have his own radio show and he's authored several books. Very well-rounded guest here today. Welcome to the show, Bill.
Annie, thank you so much. Thanks for the opportunity to talk about my most recent book. It's called Active Retirement Investing. And the fun thing about the book is I wrote it for the do-it-yourself investor if you choose to do that yourself. It has a complete list of how to do your own personal financial planning and then your own investing, and gives you a list of what to do in monitoring everything. Or if you choose to keep your advisor and pay somebody to do that, then it tells you what that advisor should be doing for you. So I'm excited because we're not trying to just sell a book. You can get it free. I can give you a link to download it, but I like the idea of empowering people to do things themselves, or at least to be able to make sure they're not being taken advantage of by somebody that's just a broker and trying to make commissions off them.
Right. So is that common?
Well, it should be. Not everybody does plan or look at their finances close enough. I think sometimes we're intimidated and it just gets to be too much for us. But as we're entering retirement or living through retirement, the cost of living goes up. So we've got to pinch some pennies. And it's a good idea to make sure that we know more about any money that's invested so you don't get scared next time it drops in value. So let's say you have your retirement plan invested and the market falls and your account falls in value. We want you to at least understand it'll be okay if you have enough money on the side and you have other bases covered. But I call that status of person a retirement refugee. We're a retirement refugee, right? We want to survive retirement or keep working, but we want to make it in a safe level. And so whether you have any money to invest or you just have to pay your bills and know which insurances to own, it's a good idea to take some time to look at your own personal situation and then go out and enjoy life knowing that it's safe. And if you live a long time, you've got resources.
It's interesting that you mentioned the financial advisors and they're just not taking their commissions. What sort of a relationship do most people have with their financial advisors? How often are they supposed to be checking in? Do they really just take their commissions and don't talk to their clients, or what should a good relationship look like?
As that book will point out, in my opinion, if you hire an advisor, he or she should be on a fee basis. So you either pay them per hour or let's say 1% of assets that they manage. But that person should look out for your best interest first. They shouldn't be making commissions at all. They shouldn't be telling you they're going to make you rich quick. They should be helping you manage your insurances, your taxes, your cash flow, and then your investments, and make sure that you're invested in well-known companies and not any side projects that they say will make you rich. So that person should be well-known. They should be belonging to a big company that's well-known, and they should do what's right for you. And it's not very glamorous. It's a lot of budgeting, accounting, taxes, but be realistic. For example, if we invest in a balanced portfolio today, our objective is to try to beat inflation maybe by 1 or 2% and keep up with inflation. We're not trying to get rich overnight. Or if you are trying to get rich overnight, make sure you buy a stock or a fund that's well known. So when it falls in value, at least you know you haven't been taken advantage of. You need to buy some more or hold on to it.
It's interesting that you're giving your book away for free. That's very kind of you.
Well, and it's a mutually beneficial relationship to the reader. I hope that, number one, people get something out of it. It makes me feel good. Okay, we all say that. But you never know. There may be an investor out there that's tired of doing it themselves. Or if the advisor writes their own book, they write all about themselves and they can't make stories up on the fly. Whatever they believe in, you put it to pen to paper, you write the book. As this book goes through the process of financial planning and investing and then monitoring, you know what I stand for. I'm not just a salesperson coming by Saturday to try to sell an investment, make a commission. So that's very important. I do it for fun, for ego. It's pretty cool to have somebody say, wow, your book is good, right? We'll do anything for an applause. But if somebody reads it and does their own investing, that makes me feel even better because they protected themselves. Or if they have an advisor, it might help the relationship with the advisor. And the long shot might be, hey, Bill, we've got lots of money to invest. Would you manage it? Of course. It's a resume for me, but it's just fun to do. I'm at the point where I don't need to take on a lot of clients, but then again, I would. So anytime you hear somebody that says, I know how to invest your money and make tons and tons of money, that's not true. They wouldn't be talking to you if they knew how to do that.
How many people are brave enough to manage their own investments? And I'd be interested to hear what's involved in the accounting side of that too. Because if you're investing under a legal tax structure, you've got certain obligations, don't you, as far as having an annual audit or something?
Yes, and everything. If people take a look at this book, I'll give you the website or the book name. But if they look at it, the first third of the book looks at their financial planning. So if they look at their cash flow and their budget, how much money are you saving or losing each month? That's obvious. Look at your taxes and your insurances to see what you need or don't need. And then it'll teach you how to look at the investment funds. I recommend regulated investment funds. It's a basket of stocks or bonds. So you may be down in value, but you don't get taken advantage of or get hurt too bad. Some of those tax favored retirement plans might be, in my country, it's an individual retirement account, an IRA, or a 401k, or something you put money in when you were working. And now you're going to have to start pulling money out at 72, as far as in our country. So there's ways to defer taxes. There's some ways to get deductions, but very few, and it's may or may not be worth the risk. So there's a fair amount of accounting and things, but it's not all that complicated. However, if it's just too much for somebody, I would hire an accountant to help you, and then maybe a fee basis only financial advisor who does not earn money on commissions.
Right. I know we're sort of talking about longevity before when I said my mother's 92. And he said, that looks good for me. However, is there still a trend for people to want to retire early, or is it more people are saying, oh, they'll have to work a bit longer because they're probably going to live longer?
Excellent question. Generally, people are going to have to work longer, and many people choose to because they see that their money's not keeping up. In a short-term trend, however, with the pandemic, a lot of people have decided to heck with this, I'm just going to stay home and retire. But they don't retire for very long because the bills start piling up for some people and they have to go back to work. So as a retirement refugee, if you will, I would recommend, if somebody's still working, really plan out the transition out of the job and make sure you have a hobby job after that. Because even if you have enough income and enough assets, you could be so bored you would be depressed, even if you have more money than you know what to do with, if you don't have purpose in your life. So I find with all the normal things that we think of at retirement, to have enough cash flow and be in good health, have things to do, have community and possibly faith, you still want to be relevant to somebody. If you think about it, especially in, let's say in Australia, you have dogs that are bred to chase animals or sheep and things. And if I'm born as a sheepdog, I live my life to chase sheep, right? If I've worked all my life, I need something to do to be helpful, relevant, and be needed for someone. And that's important to do. But there is one position, if you like managing your money, in our country, we have a great need for people to be a fiduciary and help your neighbor with their bills and managing things. And that's something that's a new position, in my opinion, that the everyday retiree who has good honesty and has fiduciary responsibility can step in and take on clients and just help them with their everyday activities as that person gets too old.
Right. That's interesting to know. We all want to lead a purposeful life, and it's quite often not until we get to our older years that we have the time to have a look around and think, oh, I've done that, raised the kids, they're off my hands. What else am I going to do?
Also, I encourage my clients, I do an annual review with many clients. I talk to them on the phone. And beyond the investments, first of all, I would recommend an investment portfolio like a Charles Schwab, Fidelity, Vanguard, or something that has several different funds in it that are all regulated by the government so you don't get taken advantage of. Learn, read the book or others, how to allocate the money and do all that. That's fine. But if we have excess money in the bank, I encourage them to put the money in their house, have it inspected, fix it up, make sure it's safer. Because if you invest it, I don't know what that money's going to be worth tomorrow. It could drop 5 or 10%. So if you have too much cash in the bank but don't want to put it in the market, then put it in your house or your car. That's fine. Make sure you have an alarm system, a panic button, a trip and fall, railings, and things like that. But the next thing is get yourself out for therapy, physical therapy, or exercising. Because regardless of your age, I talked to a woman today, she's only 83, but we've got to plan another 20 years. What if she lives 20 years? And that means you have to have a little exercise, be willing to eat right, and consider yourself like an athlete now in your last 20 years.
Yes, well, you started off as an athlete, and I suppose we all follow the same path in that we start off more active in our younger years, and then just through life we tend to slow down because we're busy doing other stuff.
And we tend to have accidents and fall down because we're in a hurry to live the rest of our life. So I say slow down, practice stretching a little bit, find out some exercises that are appropriate, clear through your doctor, and look at this, that we've got to stay healthy or we're going to have a trip and fall event and be ending up in a home. So to be independent, rebuild that house to where it's your future care facility, but let's get back into good shape, meaning walking and small things. But you now have to be more active because you want to live independently and enjoy yourself and live purposely where you have something you're doing. And if you don't know what that is, help your neighbor who's older than you.
Very wise advice. If you've gotten to the stage where you have been managing your money and it's just getting too much to keep track of all the paperwork, what's your biggest suggestion for people? for
The
retirees?
first thing would be if you don't have a lot of money invested to hire a financial advisor, they usually want to manage 100,000 or more. If you have less than that, one, read the book or books, but two, talk to your accountant or your tax person and say, could I pay you some extra hours each year when it's not tax season and help me with my bills and make sure I do everything properly? And then they might even look at your investments and give you some idea if they look like they're on track. Whether you have an advisor do that or not, the investment process. Oh, and another reason I wrote this book was to intimidate people and say, I don't want to do it. I'll hire you as my advisor. That's great, because people don't realize how much work's involved. The financial planning and investment process has nothing to do with how smart your advisor is. I graduated high school reading at the 7th grade level. I had dyslexia, and it's taken a long time to understand this stuff. But if you don't have an interest in it or you don't have the time, then we hire somebody to do it. But if you're absolutely loving it, then read this book. I'll give you the address for and download it for free if you'd like. And that can be at my full name, hunterwilliambailey.com, hunterwilliambailey, BAILEY.com. And there's a place where you can just download the book and read it later. Or Amazon has it if you want a hard copy, but anybody else's book. If you're into this stuff, learn about it. If you're not into it, hire a fiduciary, meaning fee-only financial advisor who works with a big company name. So if they fly away with your money, you can go back and sue the big company. You don't want to give money to somebody who's not affiliated with a big company name, or they could be a Bernie Madoff and you wouldn't be protected. So I would go with the big names, whichever they are in your city. The big ones that come to mind would be Vanguard, Schwab, Fidelity, T. Rowe Price, all those kinds of companies. And then the other thing is, don't think you're going to get rich quick. It's an inverse relationship. If you want to make a lot of money, you can lose a lot of money. You might as well go to a gambling casino. But if you want to make reasonable rates of return based on what you think inflation might do, then you could buy the S&P 500 fund and balance that with a short-term bond fund. There's just two funds. I would rather have maybe 10 in a portfolio, but I'm not here to tell you I can guarantee you some big rate of return. That would be illegal for someone in my position. What our job is to do is to allocate appropriately for the investor's time frame and risk tolerance within that time frame. But the investor can truly do this on your own if you would love to do it. If not, then I would hire someone.
Mm-hmm. We're in the middle of a pandemic. Who would think that a whole year and a bit more after it started that we're still in it? I suppose everyone started thinking it was going to be like 12 months or something, but now we're looking at this could be going for another couple of years. How have all the funds been performing and the stocks been performing during the pandemic? And what do you see in the future?
Well, during the pandemic, the S&P 500 dropped 38% temporarily. But if you had done a proper balanced portfolio, say 50-50 stocks and bonds and cash, you drop less than half of that. So temporarily, even being down 12 or 15 was a lot. That was scary, but you were down half as much. Then the government threw a lot of money back in and bought bonds from companies. And so the market came back. And so we're on a big ride that the market's expanding. As far as where we're going in the future, a lot of analysts believe that the global restart is occurring, even though we've had some setbacks. But globally, companies and supply chains are starting to fill back up again. Prices of lumber and that is coming down. So there's very optimistic long-term views. However, if you're doing your own financial planning and investing, you cannot count on what everybody says is happening, where the market's going. Yes, get optimistic. I'm going to be investing, but I'd be investing over the next year, a little bit each month, just in case. That's called dollar cost averaging. No guarantee that you'll do better. It just helps you ease into the market in case it does crash. And then be balanced between stocks and maybe bonds, but stocks and cash now. Bonds aren't so great. They're overpriced. But do what's right for you long term. Don't do what you think the market's going to do tomorrow, because there are 130 million investors that get on the computer and do their thing, institutional investors and computers. So if somebody says something tonight in the news, if you know how 130 million investors are going to react tomorrow, then good for you. You'll make a lot of money. But how can we predict what 100 million investors are going to react to certain news. So do your portfolio based on what your needs are, the time frame of when I might need to liquidate this money, and then the volatility that you can take. Now, you can break those into 3 buckets: short-term money at the bank, intermediate term money that can take a little bruising, like up or down 5 or 10%, long-term funds that can be wildly up and down, but you promise not to touch those for 10 years. So short-term is 0 to 1 year, intermediate is 1 year to 5 or 10 years, and then long-term. So if you buy regulated funds and manage them short-term, intermediate, long-term with big, well-known companies with low-cost, no-load funds, if you manage your time frame and your risk tolerance, you'll just be fantastic in the long term. But in the short term, you'll have money available to liquidate if the market goes upside down.
Right. That's interesting and very wise advice. So investors tending to go to funds more than own the stocks directly?
I sure hope so. Yes. Because you could have a fund, let's say the S&P 500, it will own 500 stocks. So if one of those stocks went bankrupt, you wouldn't notice it unless it was Tesla or Apple, then that'd be 5-6%. But I would rather gamble on the market's trends than a company going bankrupt. And that's why you now can do something called exchange traded funds, where they're a basket of stocks, but they can be traded like a stock. So you can buy and sell the fund throughout the day instead of wait until the end of the day to buy it. And there's some minor little tax benefits to that. So I would buy exchange traded funds, read about that in this book, and learn which ones you like. We also have a pyramid that tells you most of the funds should be total market index funds, super low cost. Some are specialized indexes or semi-managed exchange traded funds, and then a little handful of managed funds where the managers are managing the risk that you don't want to take on yourself. So the book will talk about short-term, intermediate, long-term, and then it'll also make a pyramid. We'll tell you what kind of funds to put in there, and it'll tell you every step of the way. And you don't have to pay for it, and nobody's going to call you. Just download it.
Okay. All right. And I would be interested in your thoughts on which asset class has been performing the best through all these times of uncertainty.
Well, individual areas would be the things that serve the pandemic. But generally speaking, stepping back for the last 10 years, technology stocks have done the best. However, the blue chip value stocks in the last 3 to 6 months have outperformed the growth stocks. And why is that? Well, we're worried that inflation could be going up. So maybe the government's going to raise the interest rates to slow it down. So growth stocks don't pay you anything now. They pay you in the future. And there's fear that people might just rush to the bank to get their interest. But wait, there's more. People, instead of go to the bank to earn nothing, they'll buy value stocks or blue chip stocks, which might pay 1%, 2%, 3%. And so that's why a lot of the money shifted from technology to blue chip value stocks. But it could shift right back to technology overnight. So that's why you want to have a balanced portfolio. And if I do my job right in designing a balanced portfolio, I'll never beat the market, because I never had all my money in one spot. You're always going to be disappointed. Stocks went up. Oh no, I only have half in stocks. I missed that one. Oh no, stocks went down. Oh, I'm glad I had half my money in bonds. I wish I had all bonds. Right now, bonds are overpriced, so probably use more of cash. But step back and don't think you're missing out on the market. There's a saying in this business, the market is like a train. There's always another one coming, right? So right now, the only areas that are kind of a good buy might be utility stocks or emerging markets. International, outside of the U.S., are listed at being about 25% as expensive. But there's nothing that jumps out to say, hey, go buy it. Something I wrote about in the book is avoid FOMO, or fear of missing out. Don't go out and buy what's up a lot. Gee, let's buy airline stocks. No, you should have bought those in April of 2020. It's way too late to buy airlines and cruise ships and things like that. But step back and do financial planning based on what you need. And the other thing to remember is the stock market is regulated. You can buy and sell stocks or funds. That's great. But for that very reason, you're never getting a good deal. You're getting what it's worth today. You're not buying a stock at a discount. You're buying it at what somebody else sell and buy it for 2 seconds ago. So don't expect that you got a good deal. The only good deal you'll get is when grandma sells you her house for what she paid for it. That's a good deal, right?
Yeah.
But no one's going to give you something for free. And so when you buy stocks or mutual funds or exchange traded funds, you're buying them because they're regulated and they have liquidity. But that instant liquidity means that's what they're worth in that instant. Doesn't mean they're worth more or less. That's just what it is. Now, if you can predict human behavior or the market in 3 weeks or 3 months, good for you. I'd love to hear from you.
Yes. And we don't live in a bubble. We might be in a COVID bubble, but we're all related, even all the countries, the markets, and we're relying on shipping to keep going because sometimes the airlines aren't flying as much as they used to be. So our products are getting harder to get in some cases. Even I think there was a fire in a chip factory in Japan, and that affected a lot of technology products and cars and manufacturing. So we do rely on the whole world functioning, not only just our own country.
Yes. And by the time we hear about it days later, we think, I think I should buy those stocks. Well, some computer bought them already. It's much too late. Computers can act in fractions of a second. So if bad news came out and the stock started to fall, the computer will start selling faster than we could start selling or buying. So that's why I say step back. And if you think something's going to happen in a few months, that's fine. But I would do a diversified portfolio with most everything, maybe save 10, 15% in sectors or parts of the economy that are down for one reason or another. But I would avoid chasing the crowds because by the time the crowd stops buying, then that's when the prices drop. We saw that with, the GameStop and things like that. There was no value backing that up. But there are plenty of exchange traded funds or stocks that you could buy now and you could lose 50% in resale value. That's enough risk. But the good news is if you hang on, you might come back out the other end. You might only lose 50% because the overall market's down and overall markets tend to recover. I can't say when, but they tend to. One stock, the company could crash and burn and never recover. So if I had one bit of advice, I would highly recommend go with an exchange traded fund and or an index fund where there's hundreds or thousands of stocks so you don't get a complete loss. You could lose in resale value overnight, have to wait there 5 years, but it's devastating when you find out somebody lost all their money in a stock that never recovered.
All right. Well, it's been great talking with you today, Bill. In summary, could you just give us a reminder about your book and your top tips for people that are looking after their own investing?
Sure. My first bit of advice is remain positive, happy, and realize we've lived 2 lifetimes already compared to 20,000 years ago. So let's be happy with what we have. It's amazing. And you might live quite a long time. Therefore, do look at your investments and start figuring out what your expenses are and cut any unnecessary expenses. Keep the insurances, but get rid of the ones you don't need. Look at your taxes. Is there a way to reduce those? But then look at the investments either on your own or have an advisor look at them and try to reduce any management fees on the funds. Only deal with a fiduciary fee-only advisor and try to reduce that cost. But the next step is take a big breath and realize if you have long genes in your family and you live till 100, we've got to pay for that. So think of your home if you happen to own it. How can I improve this so I can live here another 20 years and let caretakers live here? But think positively, because if you're alive, breathing in and out, and you're not in constant pain, that's a miracle. We're very fortunate, and we need to take over our own finances and at least research enough to where if you do have somebody else do it, you'll know what they're doing is a good deal. And they should be a fiduciary. And that's the amazing thing, because we're going to live a long time, right? 100 years is not going to be unusual.
Yes, that's right.
The last thing I didn't say is you can get a free copy of the book. Here's the sales pitch at HunterWilliamBailey, BAILEY.com, Hunter William Bailey. Or if you don't want to go to that website, the book is named Active Retirement Investing, The Process. And there's reviews on it. And we were in Advisor Magazine in July. So that was kind of fun. But you can get this stuff for free. You don't have to pay for anything.
Okay, well, thank you. Congratulations on your book and for the service that you're providing. Thank you very much for being on the Retire Well, Retire Happy show.
It was a lot of fun. Thank you for having me.
You're welcome.
You have been listening to the podcast show of Retire Well, Retire Happy with your host, Annie Nelson. For more information on the show's guests and being retirement ready, pop on over to my website, www.annelson.com.au, on Twitter, Instagram, and Facebook. Until next time, be happy, stay healthy, and help somebody.